Great, welcome back. So in this video, we're going to give a very simple balance sheet just to kind of orient you towards what balance sheets are for and what they look like before we get into some of the more complex stuff. And they call it a balance sheet because the assets are what the company owns and the liabilities are what the company owes need to be balanced. They need to be equal. That's why you call it a balance sheet. And as I mentioned earlier, this builds on the principle of accrual accounting. So, as a reminder, assets are everything the company owns. Okay? And it comes into the categories of current assets and fixed assets. So current assets would include cash, money that you've got in a bank account. Pretty simple. You've also got inventory. These are things like products that you have like in a warehouse or in your office that you have not sold yet, but it has a value, and therefore it's an asset because it can be converted to cash. Okay? You've also got accounts receivable. Accounts receivable means somebody owes you money for something, but they haven't paid it yet. Let me give an example of accounts receivable. Imagine, and I'll give an example from my own personal life. All right, the pool guy cleans out my pool, and then what he does is he produces an invoice. Okay? While that invoice, while he's waiting for me to pay the invoice, this is what we call an accounts receivable. It also has a value in cash, even if it hasn't been paid yet. Remember, we're dealing with accrual accounting. We count it as an asset. This cash has not been paid yet, even though it has not been paid yet. When we get to the cash flow statement, you'll see under cash accounting this is a little bit different. But this is where you keep track of those accounts receivables. Then you've also got prepaid expenses. And every business has expenses that are prepaid. Let me give some examples. Think about your insurance payments. You may pay that 6 months to a year at a time. You may prepay your rent. Things that you paid for up front. You may even prepay for some supplies. Okay? You've paid it, but you still have not gotten what you have paid still has some sort of a value that you're waiting to get, and therefore that's why we count that as an asset. You still, even though you still have that money, even though the service has not been rendered yet. You also have your fixed assets. That would be things like property. Okay? Where is your office located? Okay? You've got plants, manufacturing plants, not like a plant on your desk. And then equipment. Maybe there's like a 3D printer in your office, or a regular printer, or computers. These things all have value that can be converted to cash. And of course, normally what you do is you account for this on a cost basis. So if you've paid $500,000 for an office building and it's worth $1 million now, there's exceptions to this, but normally you give it a value of $500,000. You also have accumulated depreciation. So if you've ever totaled your car or gotten into a car accident, you know what depreciation is. Let's say you pay $100,000 for a Tesla, right? And then you wreck that Tesla 5 years later. Well, the insurance company may only give you back like, I don't know, $40,000, and they can say that that $60,000 is an example of accumulated depreciation. And you can use this same argument with I don't know, any manufacturing place, equipment, whatever, because it can be argued that since it's been used, it's not as valuable as it was when it was new. So you also keep track of your accumulated depreciation here, and you add all that together, and that gives you your total assets. Now your total assets, as I mentioned, also have to equal your total liabilities and shareholder equity. So let's have a look at this side of the balance sheet. So you've got your current liabilities, what the company owes. You've got your accounts payable. Okay? In other words, somebody has given you an invoice and you have not paid it yet. Okay? It's the opposite of accounts receivable. Okay? So let's say, I don't know, you have a retail store and you order 1,000 sweaters, and those 1,000 sweaters have been delivered to you and you've received an invoice and you're waiting to get that invoice paid. That's an account payable. You've also got accrued expenses, any of these expenses that are kind of adding up over time that you've got to pay. Short-term debt is normally thought of any sort of debt that you must pay within a 12-month period. Common examples would be things like the amount of loan repayments that you have to make in the 12-month period. You've also got other liabilities, and we'll talk more about that in some of the other videos. But anything else that doesn't match any of these current liabilities. You've got your long-term debt. Maybe you've got a 30-year mortgage payment on your place of business. You've also got shareholder equity. And shareholder equity is basically a combination of what the owner of the business has put in, plus, unless it's a negative, plus the profit or losses of the business. That is your shareholder equity. And of course, shareholder equity can increase as the firm becomes more profitable, and it can decrease if the firm is incurring losses. You've also got retained earnings. That's profit that's left over that's going to be reinvested into the business and not distributed to owners in the form of a dividend. And then, of course, you've got your capital stock. You add all of these things together, and that is your total liabilities and shareholder equity, and these two things need to even out. And this is why we call it the balance sheet. Well, great. Hope you enjoyed this video. If you did, give me a thumbs up. That's like a like. You can comment below, comment below, and you can also subscribe. I'm looking forward to seeing you in the next couple videos. We're going to do these balance sheets with a little bit more complexity, a little bit more detail. Present the same information different ways to kind of appeal to different kinds of mindsets. Hope you enjoyed this video and the other videos, and I'll see you in the next one. Great.